Today, we're going to break down one of the most powerful ideas in modern finance, the efficient frontier, and explore how it connects to beta, standard deviation, and the difference between analyzing portfolios and analyzing individual companies. Before we get into the curve itself, let's clear up one common misconception about diversification and correlation, because this is where theory and reality start to part ways a little. In theory, if you could find two assets that were perfectly negatively correlated, meaning one goes up precisely when the other goes down by the same amount, your portfolio would have zero standard deviation, no volatility at all. Your return would be completely stable, a perfectly smooth ride. But that's theoretical. In practice, you can't find assets that are truly perfectly negatively correlated. The world doesn't give you opposites that line up so neatly. There's always some common factor, interest rates, inflation, human emotion, that links assets together. Even if you could somehow approach perfect diversification, there's still a cost to reducing risk. And that's exactly what the efficient frontier shows. It says, sure, you can lower your risk, but you'll also lower your expected return. There's no free lunch. If you want zero volatility, you can buy treasury bills, but don't expect to get rich doing it. So, the efficient frontier takes that beautiful but unrealistic idea of perfect negative correlation and gives us a practical version. How much risk reduction is possible in the real world, and what return trade-off are you willing to accept? Okay, now that we've set that stage, let's move into how the theory actually works. Every investor faces the same fundamental question. Given a certain amount of risk, how can I get the highest possible return? That question is the entire foundation of modern portfolio theory, introduced by Harry Markowitz in 1952. Imagine you plot all possible portfolios on a graph. A portfolio here simply means a mix of assets, each with its own expected return and level of risk. On the x-axis, you have risk, measured by standard deviation, and on the y-axis, you have expected return. If you plot every possible combination of assets, you get a cloud of points. Some portfolios are inefficient, meaning you could get more return for the same risk or the same return for less risk. Others sit along the upper left boundary. Those are the efficient portfolios. Together, they form a curve called the efficient frontier. The efficient frontier shows the best possible trade-offs between risk and return. Every point on that curve represents an optimal portfolio, one where you can't increase return without also increasing risk. Now, what happens if we add a risk-free asset like a treasury bill to the mix? We can combine a risk-free rate of return with risky portfolios. When you do that, you can draw a straight line starting at the risk-free rate and touching the efficient frontier at exactly 1 point. That point of tangency is called the tangency portfolio. The straight line we draw is called the capital market line, or CML. Any combination along that line is better than anything below it. It represents the best risk-return combinations available once you can mix risky assets with a risk-free one. The curve shows the best portfolios of risky assets only. The line shows the best portfolios once you include the risk-free asset. That tangency point, the optimal risky portfolio, is what every risk-averse investor should hold, combined with some portion of the risk-free asset depending on their risk tolerance. Now let's connect this to beta and standard deviation, because they describe two different perspectives on risk. Standard deviation measures total volatility, how much an investment's return fluctuates overall. It includes both systematic risk, which comes from the market, and unsystematic risk, which is company-specific. Beta, on the other hand, measures only systematic risk, how sensitive an investment is to market movements. Think of it like this. Standard deviation tells you how bumpy the ride is for that investment by itself. Beta tells you how much that ride depends on the road, the overall market. If you're driving a pickup truck through the desert, that's standard deviation. A lot of bumps, but you're on your own path. If you're in a sports car on the freeway, that's beta. Smooth ride, but when the highway stops, you stop. When you're analyzing the efficient frontier, you're focused on standard deviation because you're looking at total portfolio volatility and how diversification reduces it. But when you're using models like the KPM, you focus on beta because it isolates the part of risk that can't be diversified away. As you add more assets with imperfect correlation, the unsystematic risks cancel out, and the portfolio's total standard deviation drops. Eventually, what's left is only systematic risk, the part that moves with the market, and that's what beta measures. At that stage, the portfolio's total standard deviation mostly reflects market movements, not firm-specific noise. So you can think of it as a process. Start with total volatility, diversify, and you're left with systematic volatility. Beta times the market's standard deviation. Now let's add another layer to this, the Sharpe Ratio. The Sharpe Ratio is one of the most practical tools investors use to compare portfolios along that risk-return spectrum. It measures how much excess return you earn for each unit of total risk you take, using standard deviation as that measure of risk. Mathematically, it's your portfolio's return minus the risk-free rate, divided by your portfolio's standard deviation. What makes it powerful is that it converts the entire efficient frontier into a single efficiency score. How much bang for your buck you're getting in terms of return per unit of volatility. When we draw the capital market line, its slope actually is the Sharpe ratio of the tangency portfolio. The steeper the slope, the better your risk-adjusted return. So when we say the tangency portfolio is optimal, we're really saying it's the portfolio that maximizes the Sharpe ratio, the point where the trade-off between risk and return is mathematically at its best. That's why in practice, we often use the Sharpe ratio to judge whether an investment or portfolio is actually worth its volatility. A high-return fund that's extremely volatile may have a lower Sharpe ratio than a more stable one with slightly lower returns. It's not about how fast you drive, it's how efficiently you're turning that speed into distance traveled without crashing. In finance terms, it's return per unit of total risk. Now let's connect this to the real-world difference between portfolio analysis and company-specific analysis. When you analyze a company, you're looking at earnings, margins, cash flows, and leverage. You care about unsystematic risks, things unique to that business. That's why equity analysts look at fundamentals, while portfolio managers focus on covariance matrices and factor exposures. But when you analyze a portfolio, you don't care about those firm-specific ups and downs anymore. They're diversified away. Now your focus shifts to the covariance between assets and how each position contributes to the overall portfolio's risk-return profile. Company analysis is bottom-up, understanding business fundamentals. Portfolio analysis is top-down, understanding risk interactions and optimization.